High-income child support cases may be different from routine cases that are governed by the support guidelines. In many states, the court may consider the capacity to pay child support based on the payer's net income. Net income is the foundation in many jurisdictions for determining child support, spousal support, and alimony, as well as a factor in dividing marital property. Not only must family law practitioners and their experts be capable of accurately calculating a parent's net income, but also we must learn to detect income and property by closely examining tax returns and related financial documents. Net income is also a natural starting point for post-divorce alimony, as in most states consider the net income available to the payor as well as the needs of the recipient. When determining net income for high-income child support purposes, there are several important principles to keep in mind. Business expenses. Parents who are business owners or professionals are likely to incur expenses to operate their business or practice. Business expenses might appear on a separate business tax return or on Schedule C or E of the personal tax return, or even as unreimbursed employee expenses. Take the example of an independent insurance agent who receives commission income. An agent might have to pay salary to the staff, office rent, advertising costs, or meals and entertainment. If those expenses are legitimately incurred to operate the business, they must be deducted from commissions before net income is calculated. Perquisites. On the other hand, many business owners and professionals pay personal expenses from their companies. It's not illegal to pay personal expenses from a business account so long as the payment is reported as a wage or distribution to the owner. For instance, if the business pays car insurance for the owner's personal vehicle, it isn't a business expense. It should be included in the owner's W-2 income as a K-1 distribution or as a dividend paid by the company. Divorcing business owners must keep scrupulous records of personal expenses that are paid from the business. Number 3, pass-through income. Many businesses, such as limited liability companies or LLCs, and S corporations, are treated like partnerships for tax purposes. They do not pay corporate taxes like C corps. Instead, their taxable income is reported on the individual income tax returns of the owners who pay the tax, regardless of whether they actually received their share of the profits. The owner's share of a company's taxable income is called pass-through income. The amount of profit that is actually paid by the business to the owner is a distribution. Both of these amounts are reported generally on the IRS Form K-1 that is issued to each owner. Often, distributions do not match pass-through income. In high-income child support cases, a dispute may arise from the discrepancy between pass-through income versus distributions to the owner. A business owner might have to prove that the company needed to retain its earnings for business reasons, or that the company didn't have the financial capacity to pay distributions. This issue may require expert testimony from a forensic accountant, and the owner must consider the trade-off between paying support on business distributions versus building the value of the business that retains its earnings. We tackled these issues in my book, Frumkes and Wirtz on Divorce Taxation. Take a look at Chapter 6, which deals with tax aspects of valuation and net income. For family law help in Western Pennsylvania, call me. I'm Brian Wirtz, and for more than 25 years, I've represented business owners, entrepreneurs, pro athletes, and professionals. I've represented all kinds of people with complicated child support and divorce issues. My law firm is a powerful team of lawyers dedicated to family law. In Pittsburgh and Western Pennsylvania, call me at 412-471-9000.